Okay, hello there. This is Derek McDaniel. This is my series, Everything About Interest Rates. Okay, so we've done a couple videos already talking about how interest is relative appreciation and interest is inefficient in that it reduces beneficial exchanges. And our third, at least when it's part of a debt contract or upgrading your credit. So our third video is going to be interest is discrimination based on predictions. Unfair. Okay? So the point I want to make in this video is that when you charge an interest rate, you are always going to be charging the wrong person. So in our criminal justice system, we have idea that if you commit the crime, you do the time. So whoever does the damage has to pay the penalty. Now, interest works exactly opposite of this. They predict who is going to do crimes and then charge the people who don't do crimes more. Really, if you don't default, then you get charged more. Now, this is due to the practical limitations and the lack of resource authority of the... So, due to practical limitations and lack of resource authority. Now, there are a couple of ways you could remedy this. You could have the people... Well, we'll get to that down here. But so, let me just summarize that. Your interest rate... When you're charging interest based on risk, you're always charging the wrong people. You're always charging the people who don't default on the loan based on the number of people you expect to default. Now, this is done for practical reasons. Okay. So because the bank needs to be able to, well, we'll just say the lender, because we'll get to banking next time and why banks may not actually need to profit in a conventional sense, but profit from loans at least. They should profit from providing the service of bookkeeping for the benefit of the public and the private parties. Anyway, so you're always charging the wrong person when you charge interest. If the person doesn't default, then they shouldn't have paid the interest, if the extra interest. If they do default, then they should. So how do we fix this? And the important point of how we fix this is the concept of recoverability. So when you make a loan, you're going to have collateral. So how easily can that collateral be recovered, okay? Now, there's always costs to this. Always costs involved. And sometimes the value is just lost. If you're spending on a credit card, if you go bankrupt, you may be forced to liquidate some assets you have. I don't know. Bankruptcy laws are very nice on consumers, which I think we have sort of the wrong solution to addressing our credit system. But anyway, and sometimes the value has simply been consumed. That's actually really common, okay? But with loans with sufficient collateral and stuff, you shouldn't have to charge the party compounding interest over time, so long as that asset is still there and recoverable. So the chances someone defaults on their house loan and the asset falls back to the bank is much higher than the chances it gets wiped out by a hurricane or a flood or they trash the place, even though those are possible, and they should be integrated into the cost of lending if it's going to be fair. And if you want to operate private lending as a business, which there are pros and cons to operating private lending as a business. Cons of operating private lending as a business versus public service. Okay, now it's actually a mix of both, and we're going to talk about that in the next video. Okay, so those are, it's not super complicated. Interest always gets charged to the wrong person for practical reasons, okay? And there are other financial assets like this. Similar to insurance. You never want to, ideally, you should never want to redeem an insurance claim, okay? Ideally, you get zero money from insurance. So there are other practical areas with similarities, and there are alternatives where you could refund you charge a down payment based on the cost of recovery, and then you refund that amount at the end of the loan. When everything else is paid off, you just take that recovery cost and then apply it to the rest of the loan. So in those cases, if there is a reliable and low cost means of recovery, reliable and low cost recovery means you don't have to charge the wrong person. The other thing is you can have fee. We'll talk about this later in the last video. You can have fees based on if they don't keep the schedule, and those fees can come out of your down payment. And if you keep the schedule the whole time, then that amount gets refunded. Fees can be refunded if you keep schedule. Okay, now obviously some of the justification of interest rate is made off of opportunity costs, and we have discussed that somewhat and we'll continue to discuss that. But that is also a fallacy. Anyway. Okay, so that's it for the third video here. Your interest is always going to be charging the wrong person. It works antithetical to justice. It works more like insurance, where you do the crime, you get the money. Or yeah, whoever incurs the costs gets the benefit, okay? So yeah, so it's sort of, there's sort of that conflict of interest there, and this is why our rules about debt and accounting for debt are so important, because that will determine a lot of business practices and the fairness and justice of it. Okay? So thanks for watching this, and let me know any comments or questions you have.